The central bank digital currency secret, the World Economic Forum, IMF, and banksters like Jamie Dimon don't want you to know. I'm going to explain this to you in 3 simple, fast steps. Step number 1, let's go over what constrains the banksters right now. What prevents them from just creating trillions and trillions and trillions of dollars of loans and increasing the financialization of our economy? Well, for most of you watching right now, you're probably saying, George, it's reserve requirements because they have to have 10% reserve requirements. So they can't create an infinite amount of loans. This is what constrains the banking system. So a reserve requirement going way back in the day, prior to 2020 in March, they have, let's say, a 10% reserve requirement. Therefore, they had to have 10% in bank reserves or cash equivalents for the amount of loans. If they have $100 in loans, they've got to have $10 in bank reserves or cash equivalents. But as I just said, in March of 2020, there was no longer a reserve requirement, which isn't that big of a deal because all the banks outside of the United States in the Eurodollar system, they never had a reserve requirement to begin with. But even if they did, it still doesn't constrain the banksters. Here's why. Let's go over 2 separate balance sheets. We've got Bank ABC and 123. On the left, assets. On the right, liabilities. Bank ABC starts off with 1 deposit and 1 loan. Bank 123 starts off with a loan on the asset side of the balance sheet and bank reserves. In addition, on the liability side, they have deposits for the average Joe and a deposit account for everybody's favorite Moody the millennial with their blue hair. So Joe comes over to his bank and says, I'm not happy with your customer service. I'm going to transfer my account to Bank ABC. So 123 takes his deposits, let's say he's got $1,000 in his account, and they transfer that over to ABC. So now ABC has an additional dollar liability. Because these deposits are liabilities of the banking system, they're assets of the average Joe and Moody the millennial. But they can't just transfer over a liability, they also have to transfer over an asset. So they take the bank reserves and they send those over as well. So now the 2 balance sheets are slightly different. 123, their balance sheet has decreased, where ABC's balance sheet has increased in size. Now it's just 1 loan, 1 deposit. And over here, we've got loan deposit, bank reserve deposit. But let's just say that Moody comes over and says, I'm not happy with the service at 123 either. I want to transfer my account to ABC like the average Joe did. So they instruct 123 to transfer the deposits. Let's say they have $1,000 in their account as well. So 123 takes the $1,000 of liabilities on their balance sheet. They transfer those liabilities over to ABC. But let's think this through. Here's where it gets interesting. They don't have any bank reserves or cash equivalents. All they have is this loan. And the loan is to 123. They can't really transfer that loan over to ABC as the offsetting asset for this liability. So what do they do? Does this constrain them? Absolutely not. Here's why. All they have to do is go into the repo market as an example, and they can borrow the bank reserves they need to transfer over to ABC. So at the end of the transaction, their liabilities would no longer be deposits. It would just be the dollars or bank reserves they borrowed from the repo market because they have to repay that loan. And then their assets would be the same loan that they started with. And over on ABC's balance sheet, they then would have the bank reserves that 123 borrowed in repo, along with that deposit they transferred over to them from Moody the Millennial. So what happened is Bank 123 didn't need any bank reserves whatsoever. They were able to borrow them. So then the next question becomes, okay, George, well, what if they can't borrow them in repo? Well, this is not a problem either. Here's why. These two banks have a ledger between them. I call it a ghost ledger. These are the transactions that are done in the shadows. Let me give an example. So we'll go back to Moody transferring the money. The deposits go over. 123 can't go into repo to borrow the bank reserves they need to send over to ABC. So they've got an asset to offset the liabilities that were transferred to them. So let's say 123 has a good relationship with ABC. ABC can just extend them credit. So 123 transfers the deposit over, which is a liability, and they say, you know what, ABC, we don't have any bank reserves to give you. We don't have any cash equivalents. We don't have any assets to give you. But what we'll do is we'll give you the assets maybe in a couple weeks or maybe a month. And then ABC says, okay, well, I know you're good for it. And plus, I owe you bank reserves as well. So we'll just transfer these IOUs back and forth to one another on the ghost ledger because that's in the shadows. Why? Most likely off balance sheet. So the main takeaways are reserve requirements, even if we had them, don't constrain the banking system at all. Next, you could say, well, maybe regulations like Basel III, but that doesn't really constrain the banksters either because that would just look at their balance sheets. But they've got a lot of these transactions on the ghost ledger that are off balance sheet, therefore in the shadows. They're kind of hidden away from the regulators with Basel III. So this really doesn't constrain them either. So then the question becomes, well, do the banksters control absolutely everything? I mean, how can they even go bust if they can have this system back and forth where they can just extend each other limitless credit for the deposits, which are their liabilities going back and forth? Well, what does constrain them is if there is something in the system that they need to provide that they themselves cannot create. You see, the credit going back and forth on the ghost ledger, they can create all that they want. The dollar-denominated liabilities, they can create all of those they want. But what they can't create is something like gold, something like Bitcoin. Because then what would happen is if these deposits were IOU for gold, then the average Joe could come in and say, hey, I want my gold. And it doesn't matter what type of credit system they have on the ghost ledger, they can't come up with the gold to give the average Joe. So this would limit the amount of loans they could create. This would limit the amount of liabilities they could have on their balance sheet relative to the assets, the base money, in this case, gold, as an example. The other thing would be Bitcoin. It would have the exact same effect. If gold or Bitcoin were base money, if you will, then this would actually be a constraint on the banksters in the global banking system. And just so we're all on the same page, what gives them the constraint is that the average Joe or Moody the Millennial, the customers of the bank, have an IOU for something that is redeemable, for something the banksters themselves can't conjure out of thin air. Step number 2, the whole world is moving closer and closer to a central bank digital currency. And if you don't believe me, check out these headlines. Mexico is going to be implementing a central bank digital currency by the year 2024. And I think the major economies like the Eurozone, Japan, United States is going to be right on their coattails. Now, I know a lot of you watching this video right now are saying, okay, George, I've been watching your videos since 2019, and I realize the world is moving closer to using these central bank digital currencies. This is not a secret. Don't you worry. What we're going to do is go over step 1 and step 2 we're going to combine them together to connect the dots in step number 3, where I am going to reveal the secret the global elite, the IMF, the World Economic Forum, and the banksters like Jamie Dimon don't want you to know. So let's dive into step number 2. We've got the Federal Reserve and their balance sheet. On the left, assets. On the right, liabilities. Now in step number 1, we talked about the average Joe and Moody the millennial transferring their $1,000 from Bank 123 over to ABC. And we discussed how the banks really don't need bank reserves because they can either borrow them, or what they can do is just give the other bank an IOU in the ghost ledger, in the shadows, off balance sheet. So let's think through what happens if the average Joe and Moody the millennial transfer their deposits from Bank 123 over to the Fed. So the Fed currently, let's say, has treasuries and mortgage-backed securities, and then they have bank reserves. So they have the reserve accounts for Bank 123 and ABC. Those reserve accounts are bank reserves denominated in dollars. Those are assets of the commercial banks. Those are liabilities of the Federal Reserve. So if Joe says, I want my $1,000 to go over to the Fed because they've come out with this super cool digital currency, and all I have to do is download the Fed app on my phone, and I automatically have an account with Jerome Powell. And that's way safer than having my money at those old-fashioned banks. And it's nowhere as cool as this Fed app, where I don't even have to deal with currency, or I don't have to deal with my checking account. I don't have to deal with an ATM card. All I have to do is scan the app whenever I go to Starbucks to get my soy latte. And that's probably not the average Joe. That would be the average Joe's beta male cousin saying that for sure, because he's getting the soy at Starbucks and going there most likely with Moody the millennial. But regardless, I'm getting way off track here. So if they're moving their deposits from Bank 123 over to the Fed, well, this is a very simple transaction, because the Fed's balance sheet isn't going to increase. Because the only way technically the Fed's balance sheet can increase is if it sells or buys assets, or if it creates currency. But 97% of it is buying and selling assets, such as quantitative easing and quantitative tightening. But what would happen is the $1,000 in bank reserves would go from 123's account just down into this new account that was created for the average Joe or for Moody the millennial. So again, the Fed's balance sheet would not change. My whole point here is this is a very, very simple transaction. So why would the Fed want to do this? Why would the Bank of Mexico come out and say that they are going to be implementing a central bank digital currency by the year 2024? If you listen to them, they'll say it's, because we have all these unbanked in the economy, and if we could just get them a bank account, that's how we'll get them out of poverty. As if a bank account or extension of credit is how you get out of poverty, and it's not just simply producing more than you consume. But that's a topic for a completely separate video. This is going to be their argument. It's most likely going to be their argument that if we get everyone banked in the commercial banking system or at the Fed, then it's going to reduce crime, it's going to reduce all the amount of drug dealers, terrorists, all of the usual suspects. Fear, 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 fear. Go ahead and give us all the power and the control. It's the same story over and over and over again, whether it's with the cerveza sickness or whether it's with a central bank digital currency. So their main motivation, in my opinion, is because if everyone has an account with the Fed, then the Fed will see all of the transactions happening in the real economy in real time. And even if we have this hybrid model, I think those transactions that are occurring on the liability side of the commercial banking system's balance sheet, assuming that they're businesses or maybe individuals in the real economy that still choose to hold checking accounts with them, that data will all go into the Fed in real time so they can crunch the data with artificial intelligence. Why would they want to do this? because then they no longer need the price signal that is generated by free market capitalism. And this allows them to allocate scarce resources more efficiently. And again, this is them talking, not George Gammon. And that gives them the control of the means of production. I talked about this in a video, and I'll put a link in the description below where I outline what I think the global elite's plan is to really take over the world and gain control of the global economy. And it has a lot to do with this central bank digital currency. And I think through the use of data and artificial intelligence is how they believe they can create a socialist utopia. Because what brought down Russia, among many other things, communist Russia, was the lack of price signals. So this is how I believe they'll try to get around the efficiencies of free market capitalism, price discovery, and price signals. But also it allows them to better control demand. So what do I mean by that? Well, it allows them to control what is being purchased, because let's think this through. If you're getting your stimmy checks and your UBI directly to your Fed app on your phone, they can control where you spend those Fed bucks or Fed coins. As an example, let's say they give you a specific allotment per month as far as how much money you can spend on things that produce carbon emissions. So if you spend more than, let's say, $100 on gas, then when you take your Fed coins down to the local gas station, it won't work if you've reached that $100 limit for the month. You would have to go buy an electric car, or this is how they focus demand on other things. Let's say that you're eating too much meat. Well, that's going to affect your carbon score, or how much carbon emissions your purchases are creating. Therefore, they're going to give you an allotment, just like they give you an allotment for the amount of gas you can buy. It might be a total score, or it might be broken down individually. But the bottom line is they're going to be able to control to a much greater degree what you can buy and what you cannot buy. Also, it gives them the ability to control when you buy things. So let's say inflation isn't running hot enough to bail out your drunk, insolvent Uncle Sam. That is the government, because they are the largest debtor of all time, and they need consumer price inflation to increase tax revenue so they can pay down their debt to a more manageable level, get the debt to GDP down from, let's say, 120, 130, back down to 50, 60, 70%. The easiest way for them to do that is through price inflation. So if there's not enough inflation in the economy, according to the central planners, then they can say, here's your $5,000 this month for UBI, but you can only spend it in a week. See, they're controlling when you can spend the money or how quickly you can spend it to achieve their objectives. And then, of course, lastly, they can control how much money you spend, not just through the extension of credit, we'll get to that in a moment, but also through the amount of UBI they're giving the general public. And you can see, I think we're not only going to a system of a central bank digital currency, but I think eventually in the next 5 years or maybe 10 years, actually probably the next 5 years or so, we'll have universal basic income. These stimmy checks will be permanent. And let's not forget about the supply side of the equation. If they have a central bank digital currency, they'll have far more control over who is actually getting the credit in the economy to go ahead and create more goods and services, and who is not getting that credit. So let's just assume that you've got all these mom and pop businesses. Well, they might not get those loans where Amazon might get all the free money they need to grow and expand their business. And of course, they would also control the supply side of the equation with the demand. So another way they could go about this, if they wanted to wipe out all the small businesses and give all of that demand to Amazon, as an example, is they could just say, okay, you're getting your Fed coins for the month, but you're only able to use them to buy stuff from Amazon, because all of those small businesses are not doing what we want them to do. But of course, the supply side of the equation is not only a result of an extension of credit, who gets credit and who doesn't, but it's also going back to the demand side. If the government or the central planners said, hey, we're going to give you these Fed coins, but you can only spend them at certain vendors, such as Amazon. They're taking that demand from the small and mid-sized businesses and moving it into these mega corporations that are far easier for the global elite to control. But my whole point with step number 2 is to show you that if, or maybe when, we go to a central bank digital currency, this will probably be their rationale. But in order to make this happen, there is one key component we have yet to discuss. All of these roads lead straight to banning cash. Because if there's cash in the system, then Moody, Joe, they can just go and take out their cash from the Fed and they could spend it wherever they want. They might be able to deposit it with another bank that wasn't approved, or they could just keep it in their back pocket. It would be outside of the control of the central planners. So if they want to achieve these objectives, they're going to have to ban cash. Step number 3, the secret that the World Economic Forum, the IMF, and the banksters like Jamie Dimon don't want you to know is the fact that cash was the very last thing that actually constrained the banking system. If we go back to step number 1, we learned that the banking system, if they want to, they really don't need these assets because they can borrow the bank reserves or they can just give each other IOUs on the ghost ledger. So if they have to transfer a liability without an asset, that isn't a problem. So the main takeaway from step number 1 is to illustrate how the only constraint on the banking system would be if it needs something that it cannot create. So we discussed gold. They cannot create gold. So if they need gold to give to their depositors, because their depositors are redeeming those IOUs for gold, this is something that they would need, but they cannot create. The exact same thing for Bitcoin. And to a lesser degree, because I realize the Federal Reserve or the central planners can create paper cash, but the banks themselves cannot. So this was the last thing that constrained the banks at all from going crazy and just creating as many loans as they had to, and really not worrying about getting paid back. This is where it gets very, very interesting. If you think about a system where the banks have no constraints because there's nothing redeemable, and this is a system where they can create any asset they want, but they can also create any liability they want. This is also a system where effectively the banks cannot go bust. And I know this is hard for a lot of you to get your head around. So I need you to sit down, just pour yourself that stiff drink, but then ask yourself, in this environment, assuming we had no gold, no Bitcoin, no cash in the system whatsoever, how could a bank go bust? You say, well, George, that's easy. If people just didn't pay back their loans, they'd have negative equity, and there you go. They're insolvent. They're bankrupt. Really? Well, why couldn't they pay their bills? Well, let's think about this for a moment. Let's say Bank 123 needed to pay, I don't know, their employees, payroll. Well, if those employees banked with 123, that would be really easy, because then they would just add more dollar liabilities to the checking accounts of their staff. But let's just say their staff banked with ABC. Remember, that's easy. 123 can instruct ABC to increase their dollar liabilities, and then they just give them an IOU for the assets. Or what they could do is they could get to a point where these two banks merge or effectively become one bank where they don't even need to swap assets. Let's think about this. Let's say all of the banks in the United States merge into one. We'll call it mega bank. Well, if Joe and Moody bank with Megabank, and Joe owes Moody, let's say $500, and both of them have $1,000 in their account. So Megabank would move the $500 to Moody's account. So Joe's account now would have $500, Moody's would have $1,500. But would there be any assets that would trade hands? No. The balance sheet of the bank remains identical. All they do is just transfer liabilities from here down here. And if there was nothing constraining the banks, they could do the exact same thing between one another. So again, the only thing that our financial system, the only thing that you think is money right now, meaning dollars, are simply just assets or liabilities of the commercial banking system. And if they can create these things on their own to whatever degree they want to, they can't go bust. So if they ban cash, there's nothing other than some basic accounting rules that could be changed that would prevent the global elite and the banksters from taking over the world. This is the dirty little secret they don't want you to know. For more content that'll help you build wealth and thrive in a world of out-of-control central banks and big governments, check out this playlist right here. I will see you on the next video.